Welcome back to another episode of On the House with Spartan Invest. We have a guest today, Eric Hughes. He is the founder of Rental Income Advisors. He is a seasoned real estate investor, and he currently helps everyday people achieve financial freedom through cash flowing rental properties. He built his own portfolio of single family rental properties and replacing his corporate income by age 39. That is the dream. Eric has turned his passion into coaching business that now guides over 100 clients nationwide. Welcome to the show, Eric.
Thanks for having me.
Yeah, no, we're excited to have you on and hear a little bit more. So, tell us your story. Tell us kind of how you started. We'll dive into rental income advisors, but tell us kind of how you got started in real estate in general, and were able to cash out of the corporate world at 39. That's amazing.
It's as good as it sounds, I promise.
Yeah.
So the first sort of seed that was planted was actually during when I was working in the corporate world. So I worked in the retail industry. So my longest invest gig was at Macy's. So I worked at Macy's headquarters for about 7 years. And there was a day where we were kind of standing around, and one of my coworkers mentioned, I don't know why, that he had a rental property on the Upper East Side. Right. So he had, I think it was a former primary, like where he used to live, and now he's renting it out. And I remember that kind of stuck with me because I was like, that sounds cool. That sounds interesting, right? That sounds like something successful, people do. So about a year after that, I got into it as well. So I started buying in New York, where I live, these kind of small studio and one bedroom condos in new buildings in the outer boroughs. So it was like a very sort of niche thing where I was like, okay, these are less expensive, so I can at least afford them. And, I could pick the neighborhoods, right? Because I was smart. I lived in New York my whole life. So I knew, or I thought I knew anyway, which neighborhoods were going to pop. So, those were the first properties I bought, were those little condos. And it was really because this guy had just mentioned this in an offhand way
And you did this on your own. You just kind of decided to take that plunge.
Yeah. So my goal was, I didn't want to lose money, right? So cash flow neutral was my goal. And these were probably just, for details, $300,000 to $400,000 properties. So new builds, but like outside of Manhattan. So they were in Brooklyn and Queens, and one of them in Staten Island, if people know New York at all. But
well, you've been successful with it, so I'm assuming they performed, or did they tank and you had to start over? How did it go?
Neither. They were just kind of like, okay. They were mostly cash flow neutral, right? So my projections as far as that were fine. Expenses in these sorts of units are extremely low, right? Because they're condos and they're brand new. So we didn't really have a lot of that. So they performed fine, but the whole gambit, the idea here was that they were going to go up in value, right? That was the plan. I knew it really wasn't going to cash flow. And so the idea was, okay, we'll get a mortgage, we'll go buy these properties, and then the values will go up, and that's how we'll make money. And they kind of just didn't. So I owned them. I bought 3 of these. I owned them for between 5 and 7 or 8 years, something like that. And none of them were good. In the end, when you look at the numbers, it was like, okay, well, that was money just tied up doing nothing for that time because the values just didn't go up. And then you have selling costs. So it did not work. And so that's at the end of that, or really just before the end of that, is when I kind of got exposed to cash flow investing and realized, I don't have to buy in New York. I can buy anywhere, as long as I have property management that can support what I'm doing.
And where was the first market that you ventured outside of New York?
Memphis, Tennessee, which is where my portfolio still is. So I started buying up properties in Memphis. I kept the New York condos, at least initially. And the money for those investments came because we sold our primary residence and became renters. And I'm still a renter for my primary residence, which is
really, that's fantastic.
Some people think is surprising, but wanted to put that money to work. So yeah, we bought 16 properties in 9 months. So we were sort of at a full sprint. And this is also right around the time. Yeah, I had just decided to leave my corporate career, hoping that this would work. And it did,
So
basically.
yeah, absolutely. Well,
But we wanted to move quickly. So bought up 16 real fast. And then over the years since then, we've scaled up to 25. And I've sold all those New York units in order to fund more purchases in Memphis and some other stuff.
that's great. That's awesome. So you kind of take this experience and you decided that you wanted to go into real estate investing coaching. Tell us about how you started the Rental Income Advisors.
Right. So I'm going through this big transition. I'm selling my primary residence. I'm becoming a renter. I'm quitting my job. I'm saying I'm going to buy all these properties. Right.
You are
So
flipping the table upside down.
yeah. So, you mention this to people in your life and they're like, it's worthy of a conversation, right? There's some things happening that might be interesting. So I'm mentioning this to people. And what I'm surprised by in their reactions is that they are really interested in the mechanics of it, right? So they're not just saying like, "Oh, that's cool for you." They're saying like, "How does that work, and can I do it?" Right?
Right.
Meaning, hey, how do you make money with that, and what do the numbers look like? And so, all sorts of people are asking these. What I was in sales for a little while in my younger life. They're asking buying questions, right? So I'm like, these people are interested in this model, and that actually did kind of surprise me. So that happened enough times that I realized, oh, there's this whole pool of people out there who are thinking about this or would be interested or want to do it but can't get confident enough. And so that's when I realized, okay, I could help people do this, share my expertise, and sort of build a second career, a second business out of it. So that started in 2020. So I've been basically doing it full time for almost 6 years now.
So how do you what does your approach look like? If you could kind of dive in a little bit more on how you would counsel investors who want to invest, and then, if they're looking at the near home versus going out of state, like what criteria do you set up for them? What does that typically look like?
Yeah, so I work one-on-one with my clients over usually 6 to 18 months. So the deal is I'm going to help them buy 3 properties, and we kind of cover everything, right? So we start with some prep work or get ready work on mindset. We go through then market selection. So I'll work with them on the decision about which market to choose. A lot of different criteria, right, that can go into that decision. Then we'll get into buy box criteria, right? What types of properties they want to be looking at versus those they probably want to avoid, how to run the numbers, how to evaluate properties, try to use online tools to gather information about properties. So we'll kind of set all that up so that they kind of know what they're looking for and are ready to make offers. Then I'll help them through the acquisition phase, giving them feedback on individual property targets that they find, and we'll iterate through that a bunch of times. And then hopefully get into contract and buy them. So pretty much A to Z, and then of course stuff that happens afterwards, right? With like accounting and tracking and
Yes, absolutely.
managing your property manager and dealing with any issues that come up there. So that's kind of the promise to the client is that, I've done this with over 100 people already and many hundreds of property deals over those years, but that I can help them avoid the pitfalls and walk them through that process so that they can actually do it, get off the sidelines, and do it the right way.
And the fact that you assist them after the sale. And I think that's a very big distinction, because as much as we at Spartan try to make real estate investing as passive as possible, it is not 100% passive. You should still pay attention. You should still,
yes.
You've got to pay the mortgage, and you need to know kind of how the property is performing, how your overall portfolio is performing. So the fact that you stay with them post sale is a very big benefit that I don't know a lot of coaches will emphasize. So that's really great to hear. I talk about this a lot sometimes until I feel like I'm blue in the face on how our markets, we're in the Southeast, and how our markets differ, and why our markets are ideal. So when you're evaluating different markets, I'd love to hear kind of just the high level criteria that you tell clients, like what to look for.
It's interesting. People come in with a lot of different notions, right, about where they might want to invest for lots of different reasons. So I try to steer them starting with their investing goals, right? So that's sort of what our initial conversation or kickoff call would entail in part, right? Is going to be like, okay, what does good look like for you, right? What are you trying to achieve with these investments? And in almost every case, passive income, right, or semi-passive income, cash flow, right, is part of the equation. It's something that they're interested in. And if you're somebody who's looking to create cash flow, your choices are somewhat limited, right? If you actually
Yeah.
want to sort of maximize that. And this is again a spiel I do also all the time, right? So the nature of prices and rents are such that as you move from lower priced homes to higher priced homes, rent will go up just as along with the prices, but not as quickly on a percentage basis. So that price to rent ratio will erode and be less favorable for producing cash flow. And that's pretty much true within markets, between markets, right? So a $400,000 home is going to behave like a $400,000 home pretty much everywhere in the country as far as what it will rent for, right? It'll probably rent for 2,600, right? Something in that ballpark, pretty much everywhere, maybe 2,800. But your $140,000 home is going to rent for 1,300. And that's a much better ratio, right? So when we run numbers on these properties, if you want yield or cash on cash returns, you really just can't buy the $400,000 home. You can't even really buy the $300,000 home. You have to go where homes are cheap.
Right.
That's the market where you want to be because it's going to have the highest density of actual cash flow opportunities for you. So that's the main engine that we really talk about. Property taxes are also important financially. And then there's lots of secondary factors like the size of the market, the availability of professional property management in that market, climate risk, landlord-tenant laws, right? So there's a whole kind of rubric of issues that you might think about when you think about market selection. But the main one is your engine for cash flow, right? It's your price to rent ratio. And then, so where are those markets? Generally speaking, they're in a big slice of the country that goes from the Great Lakes down to the Gulf in the middle of the country. That's mostly where all those markets are that would be considered, in my book, cash flow markets.
Yeah, absolutely. And you touched on a lot of the high ones, and especially the climate piece, and that a lot, I think that one gets brushed over a lot. And I know that we don't really talk about it excessively just because it's not really an issue in the Southeast. So you're not having to pay to shovel snow and stuff like that. Like the biggest weather concerns that we have are the extreme heat and what that could possibly do on your HVAC systems and stuff. So like we're taking precautions with that, but that's just not really something that we're talking about. But that is a very good point to make sure that you're discussing a lot.
Yeah, and two sort of different sides of the coin when it comes to the climate conversation. One is acute climate risk, right? So hurricanes, wildfires, floods, tornadoes, right? So these and big thunderstorms. So these are things where you basically know where in the country they're going to happen, and so you can kind of pick your poison. So where I invest in Memphis, of course, there's no hurricane risk. There's essentially no earthquake risk, although if you Google it, there's maybe a chance of some sort of problem in Memphis, but believe it or not. But you're not really going to have wildfires.
Right.
So, and then flood risk is something you can avoid on a property by property basis in any market, but Memphis has very little flooding in total. The only issue you have in Memphis is potentially extreme storms. So it is sort of right there in Tornado Alley, but tornadoes are relatively small as far as the number of properties that they impact. So I think about the Mid-South as a pretty good area for climate. There's also no blizzards and no extreme cold, right, which can also be difficult to manage and can put stress on your property. So that's sort of the acute climate risk. And then there's the question of the long-term climate risk, which is something that has come up with a few clients where they're saying, okay, if I'm in the Mid-South, what does that look like 20, 30 years from now as far as the heat? And that's a longer conversation.
Right.
So, I tell them it's going to be hotter. The question is, how much hotter and how much is that actually going to impact migration patterns and eventually home values? And that's a really hard question to answer. So, but
it is. That's a crystal ball question type scenario.
And what I've decided about it in my own head is that that's maybe a factor, but it's probably going to be, among all these different things I just mentioned, a pretty small factor over my investing horizon. So, I choose, if there is any risk there, I choose to accept it.
Right. Absolutely. And that's why we've seen a lot of investors kind of steer away from Florida with hurricanes and just the cost of insurance. And we get asked that question quite a great deal of like, why there is a great market in the south of Alabama and Mobile and Gulf Shores, and why we are not in that market. And it is because of the potential for hurricanes and the damage.
Yeah.
You would almost have to get flood insurance if you were in that market, and that's just going to erode your cash flow. That's going to definitely harm your overall rate of return. So that's one of the reasons why we will not go into that market, even though it's a phenomenal market. It's a growing market. But yeah, that's nail on the head there with the climate risks. One of the things that I love, I absolutely love it on your blog. I'm going to say you're saying is that cash flow is the cake, appreciation is the icing, and no amount of icing can save a bad cake. And I really I highlighted that on my notes and everything because we talk a lot about that. I know you shared your initial experience with your properties in New York and how they didn't necessarily appreciate at the rate you thought they would. So talk a little bit about why that is so important. And I'm assuming that's kind of what you preach to your clients. So just share more about that. I didn't mean to steal your quote. I just had to make sure that I said it, or that we said it, just because I love it.
Thank you. If I recall, that's from an early article, and if I wrote it today, I would modify it because, the sugar high of appreciation over the last, 5 years, if you happen to be invested, probably would save
fair enough. Very
any
fair.
kind of bad cash flow, but it was a historically anomalous period. So
absolutely, yes. If you take out the last, anytime you're talking about appreciation, I always have to do that caveat too. It's that if you take out Alabama is going to see 2 to 3% year over year appreciation. We're not going to see the huge jumps. If you take out the last few years, you do need to kind of take that into consideration. But
yeah. So there's basically, I think 2 schools when people think about rental property investing. And one is focused on cash flow and one is focused on appreciation. So the appreciation school believes that they can solve the puzzle, look into their crystal ball, and figure out which properties will appreciate more than other properties in the long run. So there's all sorts of theories around how you might do that, right? You hear things like, okay, we're going to look at population trends and investment in certain markets that companies are making, or I'm going to zoom in on a neighborhood and say, I'm going to buy in the path of progress. I'm going to do these things, right? So very common to hear that, extremely common to hear that among, real estate investors. And so those investors are not that worried about cash flow because they're saying, nice if I can get some, but the main idea is, to pick the property right and, ride the wave of appreciation. Mm-hmm. And not just normal appreciation that we'd expect, which is more or less inflationary, right? That would be the average we would expect based on a century of history. But they're saying, no, I can pick the one that's going to pop. And so this is me buying in New York, right? I had the same theory, right? Exact same thought process. So then there's the cash flow school, which I'm now in, right? Which basically says that's all nonsense, and you have no idea what the future is going to bring, and there's no way to predict this. And all of your numbers, you're just comforting yourself by imagining that you can predict the future, and you can't. And so if you truly then believe that, it sort of leads directly to a cash flow mindset, because when I put numbers to any property anywhere in the country, I assume the value will go up with inflation, right? So I'm making the exact same assumption about every single property in every place at every point in time, because it's the best assumption I can make. It's not what's going to happen, right? There are variations from market to market. There are variations from year to year or from period to period. We know all that's real. We just don't know how to predict it. So if we're in this with a long-term investing horizon, we have to make some kind of assumption. So I assume it's going to go up with inflation. And if you assume the same thing about every property, then the one thing that is different between properties is the yield that they can produce, the cash flow that they can produce. So it ends up just being much better financially as we look at this modeling to buy a property that's also, in addition to inflationary appreciation, going to kick off cash flow. So that's sort of the line of reasoning and logic that I think makes sense and that I try to instill with the clients that I'm working with.
No, that's great. And so if you are just, I have a lot of these same conversations, so I keep tying it back to kind of what we do as well. So if you're looking at a Spartan Invest pro forma, we do the same thing. We break down, hey, if you're financing it, if you're buying all cash, what your cash on cash return is, year 1, year 5, year 10, or year 15. But in kind of a subset, we don't factor in the appreciation. We'll put it in there. We'll say this particular area historically has appreciated. And again, we're in Alabama, Tennessee, and Georgia. So our markets are not sexy with the 40% appreciation, even in the last 5 years. But historically, this zip code has appreciated 2% year over year. So based on that, this is what you could potentially see. And we put that in a little, but it's not factored in the return. That's not in the calculation. And I think a lot of times when people are evaluating rental property, they're factoring in that potential appreciation in their overall rate of return, and like a cash on cash. And that's not the case.
Yeah. I mean, depending on which metric you're talking about. So if it's cash on cash, of course, that's not in there because it's not.
Absolutely.
Even if you do make that return, it's not cash, but it would be in like a total ROI calc.
Total once the property's gone. Right. Absolutely.
Right.
Yes.
Or an IRR calc, right? Depending on which metric you want to measure, it's in there. It's interesting. This topic comes up so much, and there are so many beliefs out there that are so ubiquitous and so firmly held that I was motivated to do a deep data dive, which I'm also often motivated to do in my writing. I taught myself to use Data Wrapper to create these visualizations. So I went all the way into the zip code level and market level data in Zillow Research, which you can just download. It's public. And so I was trying to evaluate things that I hear all the time from investors, things like better quality homes have more appreciation potential. Right? Would you say that like pretty much every investor believes that to be true?
Better quality homes?
Yeah.
Yes, I do. I think that's a pretty commonly common like thought process.
Yes. So like if they're evaluating like a low C neighborhood versus a low B neighborhood, right? And they're looking at that B neighborhood property and saying, oh, well, it's a better quality area, has more appreciation potential.
Yep.
I would say this is literally almost 100% of people believe this. Turns out it's just not true at all. It's completely wrong. It's not true in the real world. And the data proves it. So there's an article on my site that talks about these real estate myths. And if you're curious to dig into the numbers, or you're saying, no, Eric's definitely wrong. That better property has more appreciation potential. Nope.
We did not see that as well. Like we saw that over the last 5 years, the areas where our rental properties were on the subsets of Birmingham, from a percentage standpoint, they appreciated at a higher rate than your A+ neighborhoods inside of the Birmingham area. So I can't speak. I haven't. Years, right? Yeah, in the last 5 years.
Same thing in Memphis.
Yep. Like I can't speak for other markets, but I do know that for Birmingham, and that you're absolutely on the money with that.
Yeah, and that won't be true forever. And that's my point. It's not that like your C neighborhood is always going to appreciate faster, but over time, all properties will probably, and neighborhoods will sort of level out, right? There will be differences as neighborhoods diverge and change, but you can't just have $300,000 homes appreciating faster than $140,000 homes forever. It makes no mathematical sense. Like otherwise the difference between the two, the ratio between the two will just keep growing. So that's just not true. It's also not true that the recent price performance in a market or neighborhood is at all predictive of what's coming up in the next few years. That is also completely false. It's not real, but people imagine that it's real. They say, oh, well, this place is really on the up and coming. It's on the rise, and we can see it in the numbers looking backwards. And if only that were predictive, that would be a useful thing to notice, but it's not. And so, what I've said recently in the last few years, I'm like, show me the person who, before we sort of had this turn in the real estate market and Austin became the worst appreciation market in the entire country, the worst, right? In the last 2 to 3 years, it's lost 25% of the value in Austin, Texas, which was a big high flyer. Show me the person who predicted this ahead of time. I'll give you $100,000, right? Nobody can predict it. Nobody knows. So we have to just accept and divorce ourselves from this fantasy that we can predict home price appreciation. I'm really up on my soapbox now.
No, I love it. I love it. I'm going to switch gears for just a second. So like kind of with everything with interest rates, I know we're going to see a drop soon again, but with interest rates, inflation back over 3, any kind of regulatory concerns, there's just a lot of moving parts right now. And so what are some of the red flags or maybe caution areas do you tell your coaching clients to look out for when they're looking at markets? What are some of those red flags?
At a market level,
either at a market level or just investing in general.
Yeah, so there's a lot that we talk about when it comes to property selection, right? As far as what to avoid. The high level model, once you're sort of in the right market, is pretty solid. Right, hard to sort of find things that are really scary about it, particularly when you're using conventional financing, right? So long-term fixed rate financing. It's a really good model, right? As I think we both know. But when you do get into an individual property, there's definitely some things that you want to avoid, right? That could be red flags. So that really comes down to buy box criteria, right? So what characteristics of a property do I want to have in an ideal home? So that might have to do with, of course, geography and price point, but it might also have to do with when the home was built, what it was built from, who has been managing it, its size, right? There's all these things. And there's properties in my portfolio that I bought right when I was getting started that I would never buy today, because they kind of violate sort of one of those rules that I wasn't fully in touch with at the time. So like, just for example, I've got a couple of homes that are massive, right? I mean, not massive by home standards, but by my rental property standards. So they're like 2,200, 2,300 square feet, huge, 2-level homes, just lots of space. I would never buy those homes as rentals today. They're just too big.
Very interesting. I want to hear more about that. That's a pretty common thing, in that a lot of times investors want the bigger houses. But anyway, I'll stop talking. I'm very interested.
Yeah. So more space is just more cost. Of course, tenants do like more space. So you do get some credit for that when it comes to rent, but the trade-off is pretty bad. It's just more stuff to manage, right? So every time you turn a property, or nearly every time, you're going to have to paint. You're going to get charged by the square foot, right? So the bigger your home is, the more that costs. The bigger your home is, the more flooring costs, the more the roof costs, the more your insurance costs, if you're subject to minimums by square foot, which most providers are now enforcing. So all these costs just go up. And if you have, like, I've got a home that's like a 4, 2.5. I'm like, if you have 3 toilets, that's 3 toilets that can break. Right? So that's 3 times as many toilets as I have in some of my other homes. And thus 3 times the cost of maintaining toilets. And you can, extrapolate that to, other stuff as well. So to me, an ideal rental home is one that, is relatively small, right? It's tight, functional. It meets the needs of the tenant, but without any extra frills, right? So no, bonus room, no, addition. These are things that might be considered red flags in my book today.
That's really interesting, because I think a lot of times, and I know you see this as well, is that investors will come in like, no, I want a 1,800 square foot, 3.2, 2.5. Like, that's the ranch style brick, and those properties are great. They're fine. But if you're looking at rental properties, there is, in my opinion, almost nothing better than like a 3.1 at 1,300, 1,400 square feet. Like, that's my ideal property. That's the last one that me and my husband bought, so that is one that I preach as well on, like, you just have to take that into consideration. Big rentals aren't terrible, because you can typically make that up with more rent, etc. And sometimes you can see a little bit more longevity and tenant stay with larger homes, but you do have to offset that with, hey, whenever they do move out, it is going to be more expensive to get that property ready for the next tenant. So that's a really good point that you bring up. And I like talking about that one, because it doesn't get discussed a good bit.
And of course, it depends what neighborhood you're in, right? So if you're in a slightly higher priced neighborhood with newer homes, it's likely that they were all built larger to begin with, right? So, but if you're in sort of an older C neighborhood in these markets where homes are a little bit older, if you're in a neighborhood that was built in the 1960s, they didn't really build a lot of big homes back then, right? So your 3-1s might even be 1,000 square feet or
Mhm.
1,100 square feet. I've got a bunch of those. They're fine.
Yeah.
But if you're in a newer neighborhood, then yeah, your 3-2 might be 1,600 plus square feet, and because that's just how they built them, right, at the
Right.
time that the homes were built. So it matters, of course, a little bit on that. But in general, I've learned to be wary of big homes with lots of extra space.
Yeah. One question that I have, and when we were, kind of looking at rental income advisors and doing some research before having you on, it states that over 80% of your clients close on at least one property within 6 months. Is that accurate?
Yeah.
Yeah, that's a phenomenal number. Like that's great. Great conversion. So you're clearly working with them through all of the obstacles. What are some of those issues that you have to deal with them and work with them that might delay closing that first deal?
Well, I mean, listen, most people, right, who sign on with me have like they want to do it, right? They're not. I don't have to work too hard to sell them on like, oh, hey, you should buy rental properties. It's a good way to invest, right? So they obviously come in pretty much with that idea cemented in their head for the most part. So the reasons why people would not succeed at buying rental properties, it's sort of all over the map. It might be personal issues. It might be something else comes up. It might be that they decide they want to invest a different way, right? Occasionally that happens. So, it's never going to be 100% because it's life and it's messy and everybody's different. So, but yeah, most people who sign on with me do end up buying at least one property, and some of them many more. I've had clients go on to buy 5 properties, 10 properties, and more. I only work with them on the 3, but they stay in touch and I understand what they're doing. So probably the biggest roadblock is the analysis portion. So when we sort of get through all of our prep work or get ready work, and then it's time to sort of get in the driver's seat as the buyer and say, all right, I'm going to use my deal flow and my network here now to source properties, analyze them. That can be a sensitive point because it does take some time. So if they're overly busy, that can throw a wrench in things. And maybe they just sort of look at a handful of properties and don't find any that they think are good and get discouraged. So those are probably the sort of biggest sensitive moments in the process where there are roadblocks. Once they buy their first one and they've gotten through to the finish line at least once, then it kind of breaks the logjam, I think. And if they feel like they want to buy more, they know what to do and they've been through it at least once. So just actually going through the analysis process, sourcing an analysis process on a property and getting to the point of making that offer, that's probably the biggest hurdle to get over.
So if you could summarize, Eric, your investing and coaching philosophy just in one sentence, what would you say that would be?
So I probably just go, I guess, with cash flow is king. So
It's
I
a
think
great
that
one.
touches, yeah, it hits on different aspects of investing that we've already talked about, right? Market selection. So if you want cash flow, you have to be in certain markets, your buy box criteria, what types of properties and price points you're looking at, getting a home that's not too big, right? That's about cash flow because we don't want too many expenses, right? So it kind of cuts across. And of course, getting over our attachment to the idea that we can accurately predict home price appreciation, that's really big. That's probably the biggest one. It's and the hardest one for people because it's just so ubiquitous in real estate, this idea that there's an algorithm, there's a plan, we can figure it out. And the truth is nobody knows. And that's a hard truth to accept.
Yep. Absolutely. Well, how can our listeners or readers get started with you, get in touch with you? What's the next step if they're curious?
Yeah, so my website is rentalincomeadvisors.com. And so you can get lots of free resources there, a property analyzer, of course, lots of free blog content, but you can also, if you're interested in coaching, schedule a free consultation right there on the site and we can chat about it.
Yeah, no, that's awesome. Eric, thank you so much for joining us today.
Yeah, my pleasure. Thanks for having me.
All right, guys. And that's a wrap. That's On the House with Spartan Invest.